So Arthur, you've heard us talk about changing investment playbook, that gravity has returned to the market. Where do you see the current geopolitical, monetary policy and trade uncertainty actually play into the valuation of risky assets?
Wow. That's put it this way. I think that the world has fundamentally changed, and I think the key point here is we've moved from a world where you've had integration of global economies, you've had integration of emerging market economies into the global economy, the demographics that came with that, the production that came with that, driving down lower inflation, global supply chains, driving a process of higher growth and lower inflation for a long time, and now that is changing. So we're moving into an isolated world where we have much more focus on protectionism or home bias in that sense. We also have, geopolitical risk is clearly elevated. So, if you look at the Russian-Ukraine conflict, at the end of the day, the bottom line of that conflict is that you've entered into something similar to a Cold War situation, which is not necessarily going to end overnight, and it's going to linger for quite a long period of time. And we know that what wars do is that they worsen the trade-off between growth and inflation. So you've got these, and also it does seem to be what it's starting to do is also result in regionalization, which is pull back from the kind of world that we knew. In a world like that, as I mentioned, most importantly, worsening growth-inflation trade-off. And you're going to have to be a lot more careful in picking your winners in a world like this. And also for example, just within Asia, and you look at the Asian region, I agree fully with Laura in that the potential growth rate in China is not what it was before. I always get concerned when I see a very high elevated level of investment to GDP, along with a high level of capital stock to GDP. It's just that much harder to drive productivity. But within that region, what you're starting to see is something happening elsewhere. So you start asking the question, is India your new winner? Now, in some respects, India's got very similar problems to South Africa in terms of income inequality, but it's obviously got a lot more dynamism. It's an open question as to whether it continues growing at 6%, but if it continues growing at 6%, suddenly within a few years from now, it's really one of the three biggest, probably maybe the third biggest economy in the world. So one question is China passing the baton to India? And within that region more broadly, what you're also seeing is, with China becoming a more labor expensive environment to do business in, you're starting to see manufacturing shifting elsewhere within the region. But then at the same time, so the world is going, if you look at end of the day, what do investors want? Investors want high growth, low inflation, high productivity. And within this regional kind of like framework, you've got to look at the emerging markets of Asia more generally, and also outside of China, as being countries that can deliver longer term growth. We know about developed markets. Demographics counts against them. And in other regions like ourselves, parts of Latin America, you've fallen into middle income traps. So for me, long-term prospects for markets are always tied very strongly to growth. And that's why I look at that region. But there's going to be a lot of bumps and bruises because geographical risk is elevated. And we're seeing that. We even have questions within our own country about, support for BRICS relative to the rest of the world, or alternatively, our neutral stance towards Russia, whether that's the appropriate stance. So all of these factors are going to play in. But the bottom line for me always is I look for the markets that are going to consistently deliver the higher growth as a key differentiating factor.